Okay. Thank you so much. Excited to be here. Relatively new to webinars, so excited to be able to present to you guys and show a different outlook on what it is that we do and kind of a look into hedge fund investing processes and whatnot that you can apply to your own. You may or may not know that there is over $2 trillion invested in the hedge fund world, and very few of us, and most of us listening, know very little about them. It's really a world exclusive to the institutions and the super wealthy. And unless you fall into one of those two categories, your ticket to access is basically unattainable. And one of the reasons it is such an exclusive industry is that it is truly run by the brightest minds on Wall Street, and the funds recognized as true hedge funds usually perform extraordinarily well. And this in turn attracts a high-end clientele. And due to the performance, the price of entry just continues to rise year after year. To participate in the space, you must fit a certain financial profile and have at the very least $1 million of capital to invest. I mean, there are some funds out there that require a net worth of $5 billion and an initial investment of $100 million just to get in the door. I've had the unique opportunity to get to know many of these wealthy clients, and I've been entrenched in this world for years. So one of the main things that I've learned is that the super wealthy generally know what they know, but more importantly, they know what they don't know, and that includes the markets and investing. You'll virtually never see the ultra wealthy buy into flashy marketing gimmicks or hype. They don't chase hot stocks or hot sectors or listen to self-proclaimed gurus or TV pundits, and they certainly do not attempt to expand their wealth on their own or on their own homemade systems. The fact is that this industry, whether you believe it or not, is about 2 to 3 steps ahead of everybody. And as soon as the general public hears about an opportunity, the institutions and the real hedge fund pros have profited, and they've moved on with their clients days or weeks earlier. And little do we know, the opportunity that we now hear of is merely the leftover fruit. Now, with the quantum approach, we are attempting to change all of that. And we're basically the first company that's doing this. We hopefully give you some insight to the psychology of the hedge fund mind and its core investing principles. Now, Quantum Hedge Fund is a one-of-a-kind quantitative system that is designed for the everyday investor. The system focuses on procuring high-level institutional-grade hedge fund research and making it available to the newbie investor and even the seasoned investor alike. This top-tiered, unbiased approach studies, analyzes, and most importantly projects performance for equities within the S&P 500. It detects and moves ahead of small shifts in the market, delivering precise, real-time research to you, generating fantastic profit potential for anyone's account, no matter how big or how small. Now, this information is every bit what the wealthiest clients use and what the big guys use. Now, normally access to this system is reserved for individuals who have at least $3 million of liquid capital to invest. The reason Quantum is now available to show the everyday investor what it does is that the system and its research has actually been scaled. It's actually been scaled down. And at the end of the day, after all of the filtrations and disciplines, the system averages about 1 trade a week, sometimes 2. And you, the investor, maintain complete and total control of your money and trading accounts. You are able to implement certain components of this quantitative system to your own investment processes. Again, these trade ideas are generated by a sector-leading hedge fund's proprietary quantitative model, implementing specific algorithms that withstand several levels of filtration to ensure the most accurate research and investment education available. If you do not have the financial profile or means to participate in the hedge fund world, then this is the next best thing, and it's like nothing you have ever seen. So this gets us into our long-term capital growth relative value arbitrage. To show you, it's a statistical arbitrage. It's not an academic, and it shows so we may show the approach to taking advantage of price difference and price imbalances. these are some of the highlights we'll talk today. We'll talk about today. We'll touch on the processes, the algorithms, the mythology, the risk, all those things. So you'll be well informed of everything that we're doing. Now this approach focuses on the S&P 500. Although complex in nature, the system keeps things very simple and adds all the extraordinary circumstances that affect your ability to profit. Now ultimately, your ability to profit is measured by the market participants' interpretations of price and the ongoing battle between buyers and sellers to determine what price should be. Now these interpretations are being made by the largest institutions to the smallest trader and are influenced by several variables. These variables are such as extensive research, momentary impulse, quantitative or qualitative, brilliant or ignorant, reactionary or preemptive, emotions and feelings, logical or illogical thought, rational or irrational thought. Now these variables of the buy-sell decision-making process fall into one quantitative metric, and that's price movement, or what we refer to as PMD. And by carefully analyzing the PMD, along with all its connective supply and demand traits, we're able to optimize our ability to forecast price points and with that generate massive profits. We can assure you that by following along today, you'll be able to replicate components of this approach immediately, and at the very least, tighten up your own investment disciplines. The highlights of our system, we target returns of anywhere between 12 to 25% per trade. The system detects equities with upside potential that will at least meet this 12% return threshold. Long and short exposures in all markets. This quantitative model focuses on long and short exposures with the occasional option overlay. Only focuses on the S&P 500. It really adheres to its principal roots. It is not set up to chase a hot stock, hot sector, or penny stock. It's low correlation with the S&P 500 index. Again, it's generating about one trade idea a week. As stated in the intro, this system has been scaled, and as a result, averages about one trade a week. Again, it's not designed for day trading or any sort of quick turnarounds. Usually, the quicker turnarounds are 30 days. It's most likely our quickest. Over 10 years of research and development led to the launch of the proprietary model, along with 45 years of extensive backtesting. Over 500 positions tested, over 550 months, and over 275,000 data points tested. The Quant Advisory is designed to further the market knowledge and education of our members through detailed market research analysis. Many of the principles that we will discuss today are staples in our core trading philosophy, and many of these concepts you will be able to implement into your own investment processes. The model. Quantum employs a proprietary quantitative model and a systematic research process in a long and short equity framework. Quantitative, for those that are unaware with what a quantitative model is, it's simply a model constructed to measure. In this case, we're measuring the S&P 500. Now, the quantitative model literally ranks the 500 stocks in the S&P for internal measures of behavior, strength, and consistency. So it's ranking it 1 to 500 at real time, constantly. The long portion of the research is constructed by analyzing a basket of the highest ranked equities in the S&P 500. The short portion of the research is constructed by selling short a variable size basket of equities that display the fastest drop in rank. In other words, the system detects the fastest rising and the fastest falling equities in this structured framework in real time. Based on this data, the construction of the portfolio takes shape, and the system measures to 1/100th of a penny in lightning fast speeds, and the ranking and shuffling is in constant motion. The systematic process utilizes disciplined risk control parameters and rules for trading individual portfolio construction, and rotation. For quantum, it looks for entry points that will give the greatest probability of achieving our minimum gains threshold without exception. This is a discipline we adhere to regardless. This is something that we believe you can easily implement into your own process. Individual portfolio construction and rotation employ behavioral finance concepts as risk overlays. Now, the system constructs the positions by employing the rankings or the behavior of each equity. And based on that, the equities are being rotated and properly entered or exited. Now, the quantitative measuring process, the concepts we use that we employ to determine rank include the following. We measure money flow, accumulation distribution ratios. We measure volume, relative volume, trading range, both expansion and contraction, trading consensus, high-low divergence, relative relevance. Each concept you see here has been given a specific numerical value, which is then implemented into the model. Now, I'm not sure if you use any of these concepts to help you with your investing process. If not, these are things we believe will help, especially once you commit to continually analyzing them. Now, the key unifying components of the measuring process are time cycles being time scales, which vary across ranking criteria, parameters adjust as a function of market cycles, and the data points, just basic high, low, open, close, and volume. Basically, what we are saying here is based on equities rise or fall in our ranking system, the system utilizes time cycles and data points to properly gauge those equities, behaviors, and then weights them accordingly. For example, let's say Gilead Sciences has consistently been a high-ranking equity in the model, but yet shows an uncharacteristic drop in rank. An exit is not necessarily inevitable, whereas another equity that has been in and out of the higher ranks and shows signs of inconsistency may be flagged, repositioned, or even exited. Now, the model's indicator algorithm. These are just 3 of the 12 that we use, and I'll bring up actually another additional 3 that's not stated here, so 6 in total. But price-adjusted volume, money flow, and close-on range. Price-adjusted volume, important. A commitment study that analyzes the increase in volume relative to the increase in price over a time period. This analysis gives an indication of the desire to own a particular stock regardless of price fluctuations. So in this example we give, ABC Corporation trades one day at $50 with an average of 100,000 shares. That's a daily volume. And a year later, ABC is trading at it doubles. It trades at 100 with an average daily volume of the same, 100,000 shares. The capital, price times volume, traded on the stock went from 5 million to 10 million a day. This indicates that the market participants are just as committed to this company at the new price than they were before. And indicating more demand for the stock, most traders will only look at volume, missing an important piece of this information. Now, money flow, an intention study that analyzes the volume on a positive price move versus the volume on a negative price move. Now, when equities rise on high volume and decline on low volume, it indicates that there is an underlying intent to accumulate stock without moving the price, which is strategic buying. For example, our ABC Corp went up Monday on 120,000 shares, but on Tuesday it went down 78,000, Wednesday it went down 56,000, and up again on Thursday on 113,000. ABC Corp moved in a positive direction on 233,000 shares and in a negative direction on 134. The ratio of up volume over down volume gives a metric that helps evaluate the behavior of a stock relative to its peers. A close-on range, an eagerness study that determines where an equity closes on its range, whereas the intraday activity is a fight between buyer and seller. The closing price identifies the winner. By identifying the winner's position relative to the range, one can induce investors' eagerness. Closer to the high equals eagerness to buy, closer to the low equals eagerness to sell. For example, our company ABC fluctuates between a low of 39 and a high of 41 throughout the day. Now, if the stock closes at 40 and a half, it has closed 25% off the top of its range. When on average an equity consistently closes so closely to its range, it is a sign that accumulation is occurring. Now, in simple terms, if someone really wants to buy a product, they will go out and buy it immediately and not wait for a sale. People are very eager. For example, they're eager to buy Apple. They line up around the corner. While each indicator has been independently tested for predictive value, the model dynamically combines all 12. Additional indicators which the model employs that are not stated here: time frame volume, high-low divergence, range, expansion, and contraction. Time frame volume just measures the degree to which buyers and sellers are traders, which are short-term, or if they're investors, which is a long-term. High-low divergence just aims to determine the degree of excitement that exists around the stock. That happens more on the qualitative side. And range, expansion, and contraction, which analyzes the changing range over time. Those are 3 additional to the 12, and that's 6 total. Which brings us to the trading mythology. Now, based on behavioral finance concepts, this disciplined approach replaces emotional reactions with objective, quantitative analysis, ensuring that human emotions do not cloud timing, trading, and capital decisions. In other words, put very simply, a decision is never made on a gut feeling. Prospect theory, sunken bias, and cognitive bias. Now, prospect theory, this outlines mistaken psychological inclination to hold losing positions while eagerly selling winning positions. That is not quantitative. This is purely human emotion. We show you how to hold winning positions for the long term against the quick liquidation of failing positions. The model is designed to maximize gains and mitigate. The sunken bias demonstrates the average person's affinity towards certain sectors or companies based on past events that encourage excess weightings or holdings. We rotate and rebalance the portfolio regularly, establishing equal weighted positions in those that best fit our criteria. What we've discovered is many traders fall in love with certain sectors, say pharmaceuticals, because they've had success in pharmaceuticals or other sectors. They feel they know more about them. It's critical that you weight and balance your portfolio properly, and every big reputable firm or every big reputable fund adheres to this simple rule. Now, the cognitive bias illustrates the tendency of well-informed individuals to consistently do the wrong thing due to under-analysis. Now, we mitigate this risk by relying on extensive research. Our disciplined ranking and trading guidelines and the avoidance of panic selling or buying into exuberance, which happens all too often with others. Now, this behavior finance concept is a large reason why the everyday trader is at a distinct disadvantage. Now, some of this seems very basic in nature. However, investing is pretty basic in nature, and so is the psychology. It's when you go several levels deeper into the psychology is when you can see things that others don't and develop an advantage and develop a basically huge advantage. Now, we have values for the psychological as well, numerical values, and our model reflects that. These numerical values are plugged into the model, which brings us to our risks, meaning our market risk, our account risk, and trade risk. Now, the market risk is important because we seek to educate you on how to minimize daily volatility and monthly drawdowns during times of market staggering or major market movements. Employment of stop-loss methodologies is literally in every single trade alert we provide. Based on ranking criteria, we give specific stop-loss parameters. Some have tighter ranges than others, but they're always there. Adjustments of long, short exposures utilizing broad market trends and behavior. As market conditions change, so does our long, short positions. In fact, we are predominantly long, but could easily flip those long and short ratios. Discipline rules identify conditions to increase, decrease short percentage. If our model shows an equity to enter at $55, but yet that equity slips to 45, long-term values usually show the cost average down based on strict disciplines that are always followed. In other words, we believe in the equities that the system actually provides. Now, the portfolio rebalancing to offset natural position variation, market exposure, long-short spread balance, and position weighting. Normally, with this scaled version that we're talking about, we like to hold around 12 positions. But as conditions change, we could reweight those positions to 8 short and 4 long. We could initially we'd like to hold 12 positions, about 8 long, 4 short. But as conditions change, that ratio could change to 8 short and 4 long, or any other variation the system provides. It's highly adaptable. We do continuous scenario analysis, which facilitates refinement and optimization of the risk management techniques, which brings us to our account risk. Now, sensitive to position, beta aims to dampen the research volatility. Now, in account risk, appropriate diversification minimizes basis risk. We rebalance so the portfolio is representing different sectors. Excuse me, sorry. Again, adherence to disciplined use of stop losses and price objectives per position, event stop, price stop, trailing profit points, all keys. Percentage on trailing profit points, percentage thresholds are based upon both quantitative trigger points and qualitative reevaluation scenarios. As our equities climb, profit points are automatically implemented to mitigate the risk, and this is something that the everyday trader should implement today. A systematic volatility stop. What that means is a 2% drawdown triggers comprehensive monitoring and analysis regardless of what equity and what ranking the equity holds. A 4% drawdown triggers an in-depth portfolio review and liquidation of the weakest positions. What that means is a 2% drawdown automatically triggers analysis of that equity. Depending on rank and historical behaviors, that equity may be exited, especially if this drawdown has taken place in an equity that has recently risen in the top of the rankings. So it's recently risen. It hasn't had a stronghold in the top. Now, these type equities do not have the historical behavior, rank, or model value to hold a position in. However, a long-standing equity with high rank characteristics will be held unless it reaches the 4% drawdown mark, which then will automatically trigger a portfolio and position review and could result in liquidation of the weaker position. Which brings us to our trade risk. Disciplined trading methodologies and risk control measures seek to minimize potential drawdowns and volatility. Volatility bands are utilized. Now, volatility bands they're just indicators that allow for volatility and price levels to be compared over time. Now, they're utilized to determine technical low-risk entry points where risk-reward probabilities are highest. So basically just to quantify our price action. Entry and exit parameters are optimized in hopes to maximize our objective return versus stop-loss ratios, which is above 3-to-1. Now, risk overlays seek to mitigate basis risk, such as significant news events or company catalysts that may adversely affect the expected return, like an earnings announcement, for example. An equity option overlay may be shown to provide an additional hedge by capturing a return on equity-specific volatility, as well as mitigating gap risk. We may implement an option strategy around a company's earning announcements, just as an example. Now, qualitative research, not the quantitative, the qualitative research aims to identify information that may not be reflected in historical price data. This qualitative research is also placed with a value, a numerical value for our model. This allows for qualitative change, especially in the quantum's portfolio and its curriculum. Trading the S&P 500 equities ensures the liquidity and transparency, so it's all right there in front of you. Which leads us to our conclusive research. The average monthly return of the highest ranked selections since 1967 more than double, 2.5, the average monthly returns of the S&P 500 over the same period. In 67 was really the first year the S&P was recorded. You can find historical data. And research demonstrates a powerful association between rank and future return. A rank return regression of 500 positions, again, we talked about this a little earlier, of 500 positions over 550 months, 275,000 data points, demonstrates a powerful statistical arbitrage between the highest ranked selections and the S&P 500. Utilize robust backtesting methodologies. Multiple blind test studies were done that eliminated curve fitting. 45 years of market data ensured a wide gamut of market environments, so basically everything under the sun, and carefully accounted for potential selection and sampling biases, including survivorship bias, attribute bias, and look-ahead bias. Again, as we stated earlier, as the algorithms and the entire investment model and technology has scaled, obviously most people are scaling up. As we've scaled down to meet the needs of the everyday investor, the number of targeted positions that we are targeting is about 12, plus or minus. We look to hold about 8 long and 4 short. However, those ratios could change depending on market conditions. As we discussed, we seek to hold 12. It is not day trading. This approach, it's not chess. It's more like checkers. This approach, I'm sorry, is chess. It's not checkers. Only the S&P 500 equities are published. Full scalability, no capacity restraints. No leverage on the long side, maximum per dollar of equity, 100% long and 100% short. Same with the minimums. No subject to margin interest. Minimal monthly alerts limits trading costs and slippage. So winning positions aim to be held long-term to achieve long-term capital gain treatment based on behavioral science that we covered on the previous slides. Losing positions are shown to be liquidated quickly via the stop-loss rules that we implement regardless. The differentiating factors. Now, this is a fully proprietary quantitative process, novel and exclusive ranking system. It provides sustainable arbitrage and robust risk-return profiles. It's tested, optimized trading, and risk control rules. This refers back to over the 45 years of backtesting and the 500 positions and 275,000 data points. Unique combination of risk management techniques, stop-loss procedures limit our monthly drawdowns and volatility, ongoing research, simulation, and development. Basically, the adaptable, which makes the model very adaptable. It offers the ability to perform in changing environments. This is important, obviously, because we know how much the market changes day to day, and depending on how detailed you want to get, minute to minute. It's also a pursuit of mean of expansion versus reversion. Here's a chart of the S&P back when we can first start to measure. Very simple. If a dollar was invested in quantum back and the dollar was invested in the S&P, these are the differences in return. Basically, as we progress with our system, this is basically, we're constantly tweaking, and this is, for example, a sample trade that we gave out to our members so people listening can actually see the format. After all of the filtration, all the disciplines, all of the levels of technology that these names go through, at the end of the day, it really just comes down to a name that makes it to the top of the list. And once it makes it to the top of the list, we scrub it, and then we actually will publish it for our members. Not only do we publish the name, we actually give a full detailed synopsis of exactly what the investment model is seeing, and that comes from our actual managing partner. Here's a trade, for example, Avgo Technologies Limited. This was a relatively short trade. It was about a 30-day turnaround, close to a 20% return in a short time. So our members were able to see exactly what entry prices, exit prices, everything they need to know. Any questions, they're able to contact us and let us know via email or phone. But this is an example of a trade idea that we will give out to our members. This is another example. Alexion Pharmaceuticals, sure a lot of you know. Not that pharmaceuticals is a massive sector, obviously, but this is a trade that was more of a, in terms of a time frame, more of a realistic time trade. This was more of 60 days, maybe just slightly over 60-day trade idea. We gave a full synopsis, generated close to 45% return for our members. But again, this is an example of what our technology is seeing and what we pull the trigger on every week. We've put together a list of actual trades that the trade ideas we published up through about a year ago. But these are so anybody can see that the ones in red were actually losing trades. We do have losing trades, there's no question about it. However, this is just a basic track record of what our members have seen over the course since we actually scaled this and we opened it to members. which brings us to exactly what it is that we're doing. We offer a subscription for our membership. It's a lot different than a lot of other companies out there. We aren't necessarily in this space. However, as we move and expand our company into this space and expand our members' financial profile, we're able to offer this program because of the scalability of the system. We don't. It's a very, very powerful tool. It is not for day traders. It is not for quick turnarounds. So if that's what you're looking for, it's not necessarily for you. However, we do have many day traders on board, and the reason for that is it's more of a safety net. The names that we publish are names that they may not have thought of or been researching or whatever the reason might be, but it's simply a trade idea for them that they can purchase the options or use their own strategies on. It's more of a safety net than anything else, because you're shoulder to shoulder with this large fund, and the trade ideas that we're publishing are the same trades that the fund is actually reviewing as well. So it's about as powerful a tool as you can possibly get. We don't do a trial period. We don't do which seems to be the model for these sort of products and these sort of services or whatnot. We just don't. It's not expensive. We've priced it at $3.97 a quarter, and it's a 100% performance guarantee. You're not going to get rich overnight. But once our members our retention rate is huge, because once our members are on board, they start to get involved, they start to see the trade ideas being published. Again, it is a game of chess and not checkers. The information is proprietary, it is privileged information, and once our members sign up, they have full access to everything we're doing. Absolutely everything, every trade, all the history. And once we show them this information, we can never get it back. So we simply just don't do any sort of free trial because we can't make we just can't. The system's not designed to do anything in that short of a time. But the way it's set up is our members can cancel at any time. There's no commitment. There's no long-term commitment. It just goes quarter to quarter. Our retention rate is well over 90% because we're literally the only company that I've ever heard of that actually offers this sort of service with this level of information. So that's the way we structured it. It might be the internet's free model that everyone seems to be going towards, but we're a different company than everybody else, and that's just the way we structured it because our information is that privileged, or at least we think so. And that's basically it. You can go to quantumhf.com. I don't know if the host can post that, quantumhf.com, or if I can post that. It's quantumhf.com/sales-page.html. And you can go there. We provide basically more information, a video of the algorithms, the quantitative algorithms. We provide some more information there, and there is a place there where you can actually sign up if you'd like. Again, it's the URL is also at the bottom of this PowerPoint presentation that we have here in front of you. quantumhf.com/sales-page.html. We also have an 800 number. You can give us a call as well, 866-828-2266 if you have any questions. Other than that, I hope that some of this information sinked in. I hope some of this information you'll be able to use for your own investment processes. This is kind of the psychological way a hedge fund brain thinks, and how a algorithm and investment model was built. with the psychological aspect to it. So hope you enjoyed it, and that's all I have.